I did an analysis on gold for some time now because gold has been trending upward. And then if you look at the 4 hour charts on gold, we discovered that there was a break of structure around this region. All right, around this region there was a break of structure, and then we had this high over here. All right, and also if you check out from this region after this retracement, then we had another structure broken from here, although it's a small structure. Yeah, and then let's go to the 1 hour time and see what we've got. So I'm not expecting gold to break to the downside. I'm not expecting gold to come to this region, and then I will tell you why. I'll tell you why. If you watch closely, if you watch closely around this region, the market created a very strong range here. All right, the market created a very strong range, and of course, when the market is creating a range like this, you should expect a very strong liquidity sweep. If the market had gone down from here without this range, then I would have expected an inducement. All right, so let's assume the market just went down like this, and then I should have expected an inducement to the downside, and then but then we didn't see that. So this range alone validates this level of support for goods to move to the upside. So this range validates this level of support for goods to move to the upside. All right. So I now did my analysis on it. Though I don't really trade gold, but I just did it for a couple of my guys. Then I dropped it for them. So let's go over to the 15-minute time chart to see what we got here. All right. So if you see, all right. So if you notice, so from this region after this break of this range, we had the market swept liquidity to the downside, and then we had the break of structure. Let me zoom. So this was the first sweep of liquidity around there, right? Because all of this level you see, sorry, all of these levels are actually liquidity. They had liquidity built around them, so the market came down and took them out, and then we had the liquidity built around this key level of support. And what happened? You saw the market came down like this, and then if you watch closely, there's an inducement here. There is an inducement here before the sweep to the downside. So follow me closely. Let me make this good. Good. So over here, there was an inducement. Then we had a sweep to the downside. So this level is very important. All right. And then coming down again, we had structural liquidity built after this engagement. After this engagement, we had liquidity swept to the downside. Then we came up, and then we had structural liquidity. Then of course we now have a break to the upside. So what I'm expecting is for this market to continue upward from this region, right? It's for this market to continue from this region, and the reason is because this was where we had our engagement, and as a rule of thumb, I always want to put my entry exactly where we have our inducement. Then my protected low will be after the structural liquidity. All right. Sometimes people complain that my entries on my stop loss is usually tight. Here, I will tell you the reason why I make it like that. Before now, I was using this region as my stop loss. So I'll put it somewhere down here. I'll do something like this. And then this becomes my stop loss. But after some time, I shifted it closer because I discovered that if the market takes this guy out, the probability of the market also taking this man out, the probability of this man being taken out if this guy is taken out is very high. Alright, so I always want to put my stop loss after this particular low, right? So this is structural liquidity. If you understand liquidity very well. So now this is another confirmation that you also have to watch it for. If you watch closely, there was a low here. Okay, there was a low here, and then this is actually another block, and then it was this other block that pushed the market to the upside. So when the market is coming down, a very good confirmation is that it should take out this particular order block, all right, and then comes to sit at this level of inducement, at this region where the inducement happened. So as a rule of thumb, I'm always going to place my order at this level most of the times. This market may even come down to take it downward again before proper continuation to the upside. Alright, so I expect that this market should be going up all the way from here. I'll take this out. I don't like my chart being drawn. So just so I recap. So over here we have a break of structure, right? We have our break of structure, and then we have our new high, and then we have the market come down here, ranged and created liquidity, built liquidity around there, and then this liquidity was taken out, came back down here, and then there was an inducement here. The market came down again, created structure over here, then broke structure to the upside. Then the market should come back to be around the region of inducement before an upward move. And then my targets as usual is within this range, so I'm not too greedy. And don't forget that over here we already have a break of structure. This is a break of structure. So basically, this is what gold is currently printing, and this information gold is giving to me right now. Let me know what you think of this in the comment section.